ronda de inflación. Vamos a hablar de mercados, de valoraciones, de todo esto y mucho más con nuestro primer invitado, Robert Milano, Senior Investment Strategist and Head of Emea Equity Investment Business Development in Alliancebernstein. Welcome, Robert, and thank you for your time.
Yes, thank you very much for having me. It's great to be on here today.
Well, the pleasure is mine. I would like to ask you first about the US stock market. It has corrected during 2022. Now we are seeing quite a strong rebound. Do you think it's a good time to invest right now?
Yeah, look, I mean, it was a challenging 2022, right? No doubts about that. We had a pretty significant drawdown in the market, which was really driven by valuations re-rating, particularly in areas like growth stocks, where more persistent inflation necessitated higher levels of interest rates. And that essentially drove pretty significant downside in the market. What we're expecting kind of for this year is not necessarily for valuation to drive a lot of ongoing market volatility, but instead for the lens really to be tilted inwards on earnings. So the big question that we have is, we're kind of at a crossroads now where one direction is, do we go into recession because the Fed and other global central banks have been tightening monetary policy, rates are higher, and that ultimately leads to economic weakness? Or are global central banks able to properly navigate that environment and avert a possible recession, right? We don't know which direction necessarily the market is going to go, but we think that as we work through the next few months, we're going to get more economic data, which is going to help us better clarify which direction we believe the market is likely to go. And that will help us to at least dictate where we want to be exposed within the equity markets. So the short answer to your question is, markets in general, U.S. equity markets still have a place in investors' allocations, right? We need to be invested to drive longer-term growth of capital. The question I would say really comes down to, what is your time horizon, right? If you're an investor who's looking at a possible investment in the U.S. equity market, but you need your money in 1 month's time, what I recommend to you today, knowing that we're probably going to see a bit more volatility in the near term, as the market navigates this economic uncertainty, probably not, right? But for medium or longer term investors who can deal with a little bit of volatility, and as you said, valuations have come in a lot, now pricing is a bit more attractive, you can come in as a longer term investor. I think, it's definitely a good place to kind of work your way into the market, recognizing that it's going to be a bumpy ride for the next couple of months.
Quite interesting. Thinking long-term, Robert, for these long-term investors, many companies right now are trading at a steep discount to their historical averages. What kind of companies do you focus when selecting on your stocks, on your portfolio?
Yeah, no, it's a great question as well. And so the market itself is certainly a lot cheaper than it was, right? We think about the end of 2021, the market was trading on a forward PE of a little bit more than 21 times forward earnings. Today, we're about 18 times. And when you look at the 10-year average versus, 10-year average, it's been about 17 and a half. So we're roughly, have come back down to levels where, we're in line with the longer term average. There have been disproportionate amounts of pain in terms of valuation re-rating in areas like growth, for example, where zero interest rate policy had led to really significant buildups in valuations. We don't expect those to re-rate significantly higher in the most speculative parts of growth, given that on a go-forward basis, interest rates are likely to be more persistently high, right, compared to zero interest rate policy over the last few years. So there's certainly some areas of the market, though, where valuations have become a lot more reasonable. The question to ask, though, is why are valuations reasonable, right? There are many companies in the US where the valuation has come in a lot because the market is basically expecting that the forward earnings potential of that business is going to be impaired. Those are obviously not the kinds of companies that we're looking at, but instead, when we're doing our fundamental research, we're trying to identify companies where we think that, one, the valuations have come in and they're quite reasonable, but two, where we believe that the earnings power off of this year's base and, in relation to where estimates and kind of market expectations are today, that earnings power is solid But then, of course, where the companies have strong balance sheets and where they also have ample capital return plans in place, and kind of focusing on businesses with a higher quality footprint, because we believe that that will help us to better navigate some of the ongoing uncertainty over the next couple of months and quarters.
Interesting talking about valuations, and now I want to talk about value versus growth, because during now with the rise in interest rates, maybe if the Fed stops now or rates start to fall, maybe duration is getting attractive, right? For again investing in growth, or it's better to keep value in our portfolios because of the volatility you just said.
Yeah, so the way we've been positioned for the last year plus has been kind of a balance of defensives and cyclicality. Right, we believe that that's been a good way for us to navigate kind of the transition from what was zero interest rate policy for the last several years to kind of a more normalized market environment. One of the things we've been doing over the course within our portfolio over the course of the last 12 months or so has been reducing our exposure to growth. And that's been because we believe that if interest rates do remain higher, it's going to be more challenging for your really long duration, very speculative growth that is reliant on capital markets to finance their operations and their growth potential. Similarly, on the deep value side, we don't want to be super exposed in deep value either because there tends to be a lot of leverage. So I think kind of being focused on quality, either within value or within growth, is going to be increasingly important as we work through the balance of this year. But yeah, our exposure has been more traditional defensive and also cyclicality, and that's served us well over the course of the last roughly two calendar years. That said, we always kind of recognize that our philosophy is one that's built on flexibility, right? We're big believers as equity investors is that we have a view of the longer term fundamentals for our businesses, but we have to respect the market. And we have to recognize that while we have a view, if market conditions change and we believe that that change is going to be persistent, we need to be flexible to change that view and maybe tilt more in another direction to help deliver returns for clients over the longer term. So while we've been trimming back growth over the course of the past year or so, if we begin to see a rotation back to growth and that winds up being a lot more durable of a trend, then perhaps you see us lean back into growth. But for now, it's been certainly a bit more exposed on the defensive and the cyclical side than it would be on some of the growth.
And Robert, talking about these growth companies, when investing in the AB Select US equity portfolio, you focus on US listed equities, right? And how do you select these growth companies? Even if now you are positioned more defensive, how do you select them?
Yeah, so we have a team-based or a team of fundamental research analysts who supports the investment team. What they're really looking for are high-quality businesses across sectors. So we're looking for companies with a high and improving level of earnings growth. We're looking for strong and organic growth in earnings and cash flows over a longer-term time period, so typically three to 5 years forward. We're looking for companies with strong balance sheets, with strong capital return plans, so dividends, dividend growth, buybacks, and that's essentially the underpinning of what we're looking for. But then again, retaining that flexibility for us to allocate amongst our best ideas where we believe that market conditions are going to be most favorable. So we might own something for 10 years, and it might vary in weight quite dramatically over the course of that period when, say, for example, one particular sector might be out of favor, while the longer-term thesis on that name might be intact. You might see us reducing exposure, keeping a small position, and then allocating elsewhere within the portfolio where we think that conditions are a bit more favorable, so that once again we can deliver upon that goal of longer-term risk-adjusted performance for clients.
And are you concerned, Robert, about, you talked recently about the Fed keeping interest rates higher than normal, but is this going to shape your investment strategy?
It's definitely something that we're looking at, right? While we are fundamental analysts, at heart, and we're looking at underlying businesses, there is absolutely a macro element to what we do, which helps us to shape the portfolio. So it comes up very often in our investment discussions with regards to what do we think the direction of policy is going to be, how does that then inform broader, the broader impact on the economy, and then ultimately earnings, right? So this is all going to flow through to the underlying earnings for companies, and that's something that we need to be hypersensitive to. As we work through the balance of this year, we haven't really felt the impact, for the most part yet, of much of the Fed and other global central banks' tightening efforts. So that will create more challenging environments on a go-forward basis for some companies. There will be others that are better able to navigate some of that uncertainty, and that's what we're really trying to isolate, are those companies that we think are well positioned for this environment where we can deliver that long-term growth of capital for clients.
Robert Milano, Senior Investment Strategist and Head of Emea Equity Business Development in Alliancebernstein. Thank you very much for your time.
Thank you very much. Really appreciate you having me today.